My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little bit of money here. My job, not just to entertain, but to educate, maybe throw in some teaching. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. You might not know this, but I'm a gardener. Pretty lame, tame hobby by Wall Street standards. Built my first garden in 1988. We gardeners, we love sun. We love our flowers basking in the glow. On a sunny day, we can almost feel the plants grow. But too much sun scorches the heck out of the plants. You can burn out the tomatoes. Zucchini leaves get those white freckles that you hate so much. Beanstalks may never appear. So we want rain. We don't just accept it. We covet it. I bring this up because rain is to gardening as sell-offs are to the stock market. You should expect them, maybe even hope for them. We just don't realize it at the time. Like today, Dow dipped 26 points, S&P lost 0.49%, NASDAQ shed 0.90%, was uglier at one point, pretty ugly. So tonight I want to sing the praises of rainy day sell-offs like this one and explain how to use them and why you should like them. First, let's look at what happens when you don't get enough rain. That is the story of the great run-up at the end of the dot-com bubble from 1999 through the first quarter of 2000 that people are always referring to, but they didn't live through it like I did. If you weren't around back then, you might not know that there was almost no rain in that market, just scorching sunshine day after day. We had stocks of worthless companies going up and up and up, nurtured by the sun of reckless buying by both individuals new to the market and growth-craving mutual funds who just were the scourge of the market. These buyers never took a break. If you got to sell off, it was only for just a couple of hours, not days, as buyers could not resist throwing money at anything that looked like an internet company or one that helped them. It was a market full of what we call parabolic moves. That's where stocks go straight up and never even go stair-step. This is a pattern, by the way. I don't mind at all. What only happened in this Mojave Desert style of bull market? Pretty simple. We went up so much that we were deluged with two things: secondary offerings from companies, that's right, raising new money, and massive insider selling. Now, these bogus stocks moved up on very little volume. So when they were finally inundated with insider and corporate selling, the stocks just wilted. More than 300 of this newly minted companies in the 1999 to 2000 period embarked on these wild and crazy trajectories, where after gigantic moves, a torrent of selling hit the market, and they crushed the individuals and the mutual funds that invested in this dross. People lost hundreds of billions of dollars, and many never came back. Now, I have spent the last 25 years trying to prevent people from sticking their necks out too far in these kinds of fly-by-night markets. And I will shout from the rooftops when I see one. When I saw a similar move in the chimerical stocks last year, I labeled it the year of magical investing to spoof it, make people aware that the whole shebang was living on borrowed time. Sure enough, the entire group collapsed in the fourth quarter. Many people again got hammered, but fortunately nowhere near the destruction of year 2000. Many of you are still with us. Despite what you may hear right now about the data center and the overextended nature of a handful of stocks, this period is nothing like that one. Sure, we got too many parabolic moves, but unlike the dot-com era, the year of magical investing, the companies that are moving up strongly are real, meaning they have sales and earnings, and their prospects are extraordinary. Many have great balance sheets, especially if they're in memory or storage or processing of data. The bad news, though, is the if in that sentence. Today, the Wall Street Journal ran a story that basically said one of the chief pillars of the artificial intelligence rally, OpenAI, may not be doing as well as you and I thought. It may not have hit key benchmarks as you and I thought. It may have over-ordered as you and I thought. And to read between the lines, it may bring the entire edifice down when the company, well, let's just say, tells us the truth. How about that? When I read the piece, I was reminded of all the amazing hatchet jobs that I was forced to write in my multitude of journalistic haunts when I was younger. They ended up coming easy for me. You know why? Because you just have to pose enough truthful questions that the sum total is a death sentence for whoever you're writing about. After just a few months, you know what? I gave up fighting to be constructive and just decided if my editors wanted a hatchet job, I would give them a hatchet job. This journal piece was right in my wheelhouse from the old days. put the fear of God in people. And you know what? I loved the article. Loved it. Why? Because it gave us the rain I was looking for. We needed some rain to shake out the summer soldiers and the Sunshine Patriots. Thank you, Thomas Paine. This article was filled with such a hailstorm of fright that it finally caused an AI-related sell-off that this market needed so badly. Thank you, Journal. It was like rain. But you know what it also reminded me of? Fertilizer, the natural kind. I found it hard to believe that things were as laughable and pathetic at OpenAI, the artificial intelligence kingpin, as the article made it sound like. What a laughing stock. Hey, maybe that's because, you know what? I was thinking, why do I like... It's because I trust the CFO of OpenAI, Sarah Friar, whom I've known for ages, and has never bagged me. Now, it's entirely possible that she woke up this morning and she said, today is the day I'll make a national fool out of Jim Cramer by telling him things are great when they're really awful. But one, I don't think I'm that much of a priority, and two, she's too honest for her own good. Sure, OpenAI has issues. Oh, yeah. But it has not paid to bet against it so far in practice or in theory. Still, if I thought that OpenAI were Lucent or Nortel or Global Crossing, the real, let's just say the worst of that period, if I thought that you were going to lose money because of this, do you think I wouldn't shout it from the rooftops? I don't play for dinner. Let's go back to the rain metaphor for a moment, though. We're on the cusp of the big four tech earnings, Amazon, Alphabet, Meta, and Microsoft. And that could all disappoint if this article has substance. Honestly, that's exactly what this market may need, though. We need a shakeout of the fair weather soldiers and the fair weather shareholders. And we actually need to have some shorts built in. That's what rain does. That's how a market can continue. Otherwise, it will go bubblicious. We're also seeing a host of other stocks that have gone parabolic. ARM Holdings, which we own for the trust, Dell, AMD, which I wish we owned for the trust, and Corning, which reported this very morning. These stocks had threatened to touch the sun. Corning flew too close and had its Icarus moment today, tumbling nearly 9%. I told members of the investing club that it didn't really matter what Corning said, because its stock had gone parabolic, running so much that disappointment was indeed inevitable. Sell, sell, sell. It didn't matter that the company announced two huge clients, something that would have normally sent the stock barreling into the sun. Instead, it reacted to the rain and got clubbed. I say good. Corning needed that too, even though my trust owns it. It's what we needed to see. Now, do all these parabolas mean that the entire move is kaput? No, not at all. What can you do to protect yourself from them? Here's an idea. The pros do what we call schnitzeling, taking a little bit out of the stock on each day of the parabolic move. You have 200 shares, you sell 50, and then you wait a little bit, then you sell another 50. If it keeps going higher, don't sell it all, but make sure that you've sold down some. Then if the stock drops 5 to 7% from where you first sold, then you can begin to buy it back slowly but surely, 25 shares at a time. The goal is to be able to take advantage of the rain and do some planting further down. Otherwise, these sells feel like a seal clubbing expedition where you are the seal. I don't want that. What makes me so certain things are okay? The fourth industrial revolution. That's what. Do I know if OpenAI is going to be the best investment ever? You know what? Frankly, I don't care. What I care about is owning the stocks that are best prepared to benefit from the need to have compute, storage, and power. The three shortages that are driving the moves, like the one in Seagate this very evening, a memory disk drive, which just reported after the close is up 100 points. Of course, I keep the Chapel Trust diversified. We own a lot of companies for the trust that are not in the more or less malign data center space. We handled the nasty downdraft of tech innuendo when NVIDIA was 40 or 50 points lower than it is now. We'll handle that, too. Here's the bottom. I'm not worried about the rain. My bottom line says newspapers, hedge funds, managers, panelists, commentators, you name it, bring it on, especially the gas bags who can drum up a storm if they have to. Instead, I worry about a lack of rain that will cause this market to self-immolate. Fortunately, today we got a nice shower of selling. Don't worry, more showers ahead. Can't handle it? Buy an umbrella. Brian in North Carolina. Brian.
How's it going, Jim? How's it going?
It is going well, Brian. We got the sell-off that we start to need in order to be able to cool things off so that we can refresh and go higher again.
Yes, absolutely. So I'm from Charlotte, North Carolina. B of A's headquarters are here, and I didn't know. I was just calling to see if you thought B of A was a buy or sell.
B of A is just a plain-out buy. The stock, first of all, is down 4% for the year. That's ridiculous in itself. Second, it sells at 12 times earnings, and yet it's incredibly well run. This is an example of why I say this market's not dangerous. Bank of America is way too cheap. It should be bought. Let's go to Tony in North Carolina. Tony.
Hey, Jim. Thanks for taking my call. I'm a first-time caller, club member, and I never miss your show.
Oh, thank you, buddy. Thank you.
Anyways, back 2 months ago, I bought 300 shares of Marvell Technology at $85. Today, I sold half of those shares for $150. So the question I have is, what do I do with the shares I have left?
You're playing with the house's money, my friend. Here's what you do. You let it run. I think that you've got a total winner in Marvell, and you know what? You're not going to lose. What a great position. You're playing with the house's money. Let it run. If it gets to 200, maybe take a little off. Look, I'm not worried about a rain shower every once in a while because sell-offs like the one we got today are healthy for any bull market. Without it, we'd be in danger. On Mad Money tonight, shares of Nucor are surging after the steelmakers blowout earnings report, and I'm getting the latest from the CEO to see if there's more upside ahead. Then as we wait for earnings D-Day tomorrow, I'm running through where things stand so far for the market this earnings season, and it's not bad. And baby boomers across the country settle into golden years. I'm sitting down with the CEO of one of the largest operators of senior housing communities to get the latest on the trend. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.